Welcome everybody to today's webinar, SMSFs and separating members, how relationship breakdowns impact self-managed superannuation funds. So look, this is an interesting subject matter, one that I've certainly had a great deal of involvement with in my many years in SMSF administration, and over time I've seen the practices I guess change, albeit that in many instances they don't change significantly, and many times it's more about how we practice it in the actual admin space more than anything else. And so the disclaimer to me is probably a pretty important one for today, because I guess this is an area of fairly technical and legally oriented specialist or specialisation for self-managed superannuation funds. And so whilst I'm providing a little bit of a practical guide and practical overview, certainly I'd be suggesting that in most instances people seek the appropriate legal advice. But look, it does give weight to the question of how much support and how much impact can we have in this space if we are SMSF professionals, and it's certainly an area that I think some sort of guidance is warranted with regards to parties as to the various rules that can apply, and particularly the taxation consequences and compliant risks associated with doing superannuation splits. And you know, we know that in a ongoing sort of COVID environment, the concept of cabin fever amongst other things has set in some instances, and we know that there are clearly separations occurring out there. But the other thing that we notice, and I've noticed this particularly in the admin space recently, is that more and more self-managed superannuation funds are being set up at younger ages. And I guess if we look traditionally back at sort of 2002, when the Family Law Act and the superannuation regulations were amended to incorporate a number of the splitting processes, you know, the average age of a self-managed super fund member was a lot higher then, and so therefore the likelihood of separation was sort of fewer and far between, albeit that you did see it. It wasn't probably as regular occurring as it perhaps is. And I think probably it's fair to say also that over that 20 years or thereabouts, that whilst the legislation has remained relatively similar, there's been a few minor changes along the way. You know, self-managed super funds are one of those areas that are provided for legislatively, but probably not to the supporting degree as they are in a number of other sort of regulatory areas where we have much greater guidance as to what to actually do and what to undertake. And I think that can be a problem in the SMSF space, because it does provide greater reliance on potentially and particularly the legal fraternity. And you know, one thing they say for certain is that generally the only winners in any separation is the lawyers, and the same can be said when you start to look at utilising various legal practitioners to undertake the separation of superannuation assets. Not to say that they're not a necessary part of the transaction, as it can be quite daunting and quite confusing. Having gone there and having gone through this process myself over recent sort of times, it's an area that whilst the intention of myself and my former wife are fairly clear with regards to what we want to do, you know, it's not necessarily that easy to just put it down in paper and have it agreed upon. So you've got to go through various steps to undertake it. You know, and I feel that we certainly are getting to the point where we're comfortable with our final decisions, and are ultimately entering that engagement stage to go through this actual process with our self-managed super fund. So this training session is as much for you as it is, or much for me as it is for you, as to the processes and steps to go through. So look, we're going to talk about the admin side of things a little bit today. We will touch on consent orders versus superannuation agreements, to the extent of how they can differ, particularly in the admin space. And I've got a great example of where things can go wrong in the superannuation agreement point of view, particularly from a strategic planning position. And that's not to say that I don't appreciate what superannuation agreements provide for, but it's also what they could potentially provide for and how we can try and avoid that. And that's a big role that we can play. And then looking at the whole asset transfer thing with self-managed super funds. So finishing off on a couple of the practical terms along the way. So certainly what we'll go through is that the requirements for preparing superannuation agreement, the capital gains tax exemptions, the acquisition of asset exceptions that apply, and then the process and supporting documentations necessary to effect a payment split. So as always, if you've got any questions, please throw them in the Q&A box. Everyone will get a copy of the presentation after the event. So I am working through a number of my outstanding admin issues, so hopefully that's not too far away. So let's start with a bit of an overview of I guess the entirety of the process, but also I guess for myself a snapshot of some of the key issues that we need to contemplate as SMSF professionals when dealing with specific self-managed super fund clients. So broadly, before 2002 and specifically December 2002, superannuation's always been a financial asset, and it was taken into consideration with references to relationship breakdowns, but it wasn't considered property as such, or property subject to a split. So whilst court orders and previous hearings prior to 2002 would often contemplate splitting superannuation, they ran into the barrier that superannuation law didn't provide for the actual payment splitting process. And so what we saw was amendments to the 1975 Family Law Act. We saw amendments specifically to the SIS regulations, and we saw the introduction of the family law superannuation regulations back in 2001. And so with all of these pieces of legislation working together, we've got to the stage where largely sort of unimpeded, these rules have remained in place with some tweaking around issues such as CGT relief and the like along the way to benefit certain parties. But we've been set with this primary set of rules that we need to follow through, and that parties who are separating, whether they're married or in a de facto relationship, need to go through in order to split their superannuation. And I guess that's one of the first key messages, is that if people think that they can just split their super by paying their benefit either out of the fund or doing an internal rollover from one member to the other, then they're going to create a whole heap of other compliance issues within their fund as well. Hence the requirement to seek some form of appropriate advice when going through this stage. So when we look at it from a process point of view, and you can sort of tailor a few of these, you can extend it out and make it more sort of process points if you choose to. But there's the key first step, which is the information gathering. And when I put the invitation out for this event, I highlighted the laws that are coming into effect from the 1st of April 2022, which is giving non-member spouses the capacity or fund trustees the capacity to or parties, should I say, to a splitting arrangement, giving them the capacity to go to the tax office to obtain information about a member spouse's superannuation benefits, and then that would trigger the process that we were looking at today, which is obtaining information from that superannuation fund and then going through the steps associated with documenting the decision in that. So the information gathering, largely for a self-managed superannuation fund, is a relatively sort of straightforward process if the self-managed super fund is the only fund that either the member or the non-member spouse, so the separating parties, have from a superannuation point of view. Once we start to delve into other superannuation accounts and potentially define benefit interests and things, then the process does get a little bit complex, and that's not the scope of today's presentation. We're really just focusing on the SMSF side of things today. So then we're going to go through the stage once we've got the information, so we know how much each member might have in their various superannuation interests within the self-managed fund. We go through the idea of, okay, well, how are we going to do this? Are we going to do a super agreement, or are we going to go through the courts? And I'll touch on both those processes, as I've said. And then the payment type and the payment method. So are we going to implement a splitting order, or are we going to implement a flagging order? Are we going to do a percentage-based split, or are we going to do a dollar-based base amount type of split? And so all of these decisions, it's fairly important that people understand the ramifications of each decision, particularly in my sort of mindset, the way that we're going to value the split, whether it is going to be a base amount or whether it is going to be a percentage amount. And often people differentiate between those two based on pensions versus accumulation. But I think, we've seen a lot of market variables over the last sort of 2 decades that would suggest that the base amount in some instances will benefit or not really provide too much of a benefit either way. The percentage one is always just going to be fairly evenly proportioned. But where you do have wild market swings both up and down, then it can either significantly benefit the non-member spouse, or it can benefit the member spouse, subject to how the fund investments are performing and the timing of transactions as well. So, a couple of key messages to be mindful of in undertaking the actual process. Then once we've gone through that, whether it's the agreement or we go through the courts, then we've got the serving of the notice. So again, giving the information to the trustees of the fund, and then notifying the appropriate parties, so notifying the members. And so I guess this is where not the contradiction as such comes in with the process, but this is where we all sit back and go, well, hang on. So everybody involved in this process to this point are generally the same 2 people. So the people that we're requesting information from is ourselves. The people that we're providing that information to are ourselves. The people that we're deciding on the documentation are largely the same couple. How we determine the payment method and split, same people. Who do we give the notice to? We give it to ourselves in the capacity as trustee. Then we notify ourselves as a member. And then we implement the actual process. So it is largely in an SMSF space quite a contracted process with regards to the number of parties involved, but it's still critical to make sure that we get everything correct in order to make sure that there's ultimately no recourse at a further point in time, and largely that's why we go down either the consent orders or the superannuation agreement approach from a compliance point of view, because if we're not getting the right sign-offs along the way, then there's nothing to suggest that something can't be challenged at a later point in time. So what I wanted to address is the industry that we operate in has largely manufactured some terms around what sort of funds we operate, and given that we operate under a single 17A definition self-managed superannuation fund, which is no more than 6 members. I won't half mix up my definitions there. No more than 6 member self-managed funds, but we've incorporated the concept of family self-managed superannuation funds, which is largely where they started, which is in a sense any members of the family can join the fund. Often these funds, and largely these funds, are spousal based funds. Right. Then we have the concept introduced probably in recent times to counteract certain estate planning obligations, and of course with estate planning obligations also comes family law matters to contemplate. But where we've got bloodline self-managed superannuation funds, so the concept that we've got to have that bloodline to be a member of the fund. As I said, these are more sort of marketing and directive approaches rather than actually legislated style arrangements. You've then got your single member fund. Now, of course, the single member self-managed superannuation fund, means that we are definitely working in an environment of a member spouse versus a non-member spouse, and something to be mindful of. And then probably the more awkward scenario, or equally as awkward, but the parties involved make it more so, the associate-based self-managed super fund. So where we've got non-related parties, it might be business associates that have a self-managed superannuation fund, and how we obtain information and how we deal in that set of circumstances is certainly a little bit more difficult and more specific. And so our superannuation kit, we can obtain this information from the Family Court's website. They've got a great superannuation information kit there, and then part of that is the Form 6 requirements. So the Form 6 is when we make a declaration requesting the information from the trustees of the fund, and informally, self-managed super funds will often not undertake this step. But I suspect that where we will see it, and I come back to that concept of more younger members setting up self-managed super funds, is if we are operating in an associate style super fund or a single member fund or a bloodline fund, that you'll see more formalities introduced over time, where appropriate requests are being made through the Form 6, and then the trustees are providing that necessary information back to the non-member spouse. So under the Form 6, they're making a declaration that they're entitled to the information, that they are the non-member spouse, and then certain information is going to be provided back to them from the trustees of the fund. So, I see that there is effectively a more informal process that applies to your typical spousal fund. And let's say that represents at least 50% of self-managed superannuation funds. If we know that close to 70% of funds are two-member funds, then the vast majority of them are going to be spouse-based funds. And so in that instance, other than where the parties have separated and there is obviously the communication barriers, they at least both know that the fund exists. And so in this instance, this reference of referencing and requesting information via the ATO is less likely in that family SMSF scenario, versus the other arrangements where we might not know or have the information about a member being a member of a self-managed superannuation fund. And so we need to obtain that further information. And so it leads on. I've already used these terms a little bit in the presentation, where I've referenced member spouse and non-member spouse. And I guess the key to these terms is primarily about the differentiating between the family law provisions and superannuation and your stock standard superannuation provisions. So these terms are specific to the interests that are being split from a superannuation point of view. So the member spouse is the member who has the interest in the superannuation fund, which the split is applying to. The non-member spouse is the person who the benefits will effectively be transferred or paid out to. But of course, in the SMSF sense, both members can be both the member spouse and the non-member spouse. And of course, that then will create confusion amongst the individuals, because they say, oh, hang on, why are you calling me a non-member spouse? I'm actually already a member. It's like, yes, you are, but for the purposes of the family law split, you are the non-member spouse, because we are obtaining information about your partner with a goal of transferring benefits from their interest to your interest. So it's a communication piece along the way. And what is interesting is that the SIS Act, interesting is I guess a term of choice there, but what is important to note is that self-managed super fund rules dictate under 17A that basically, your fund meets the definition, and you have ultimately 6 months to rectify the definition of a self-managed super fund if members leave because someone has passed away or a legal personal representative is appointed, and all those other sorts of circumstances. You've got 6 months to rectify and retain the complying status of the fund, unless a new member is added. Now, this regulation 104 AAA provides that 6 months to a non-member spouse. So the non-member spouse is ultimately becomes a member for all intents and purposes with reference to being a part of that fund from effectively the ladder of the operative date or the notice being served to the fund. So they become a member subject to that superannuation interest split, but the fund trusteeship and all those sorts of things, you've got effectively still that 6 month window before any of the administrative and compliance side with the ATO needs to be sorted out. But once you hit that 6 month barrier, and they are deemed to be a member for all of those reporting obligations under 17A, then it's important, if they are still in the self-managed fund, to meet your obligations. And this is one of the interesting things, and in my sort of 20 plus years of doing this, I can say hand on heart that I've seen one self-managed super fund where the members have remained as members of their fund post separation, in a genuine separation situation. And that was largely because they were maintaining and operating a business still together, and they had assets of that business, property assets inside the superannuation fund. And they felt that whilst they were accumulating and paying those benefits, that it was suitable for them to remain in that fund. Now, that's obviously the minority, but there's no requirement under any of these splitting laws that you actually have to leave the fund, other than the reality that in most instances, if the relationship's broken down, then the likelihood of you actually wanting to remain members of the same self-managed superannuation fund is fairly minimal. So we've got our memberships and our different terminologies there. Then we have the order type that we're actually going to apply. Now, largely this gets broken down into a splitting order and a flagging order. And again, in the sense of self-managed superannuation funds, I think I can comfortably say one. I think I've seen one flagging order for a self-managed superannuation fund, not to suggest that they don't exist, but that's ultimately where a member's benefit is flagged and nothing can be paid out of that benefit until such time as a condition of release has been met, or a certain condition has been met. More often than not, you'll see this with defined benefit interests. But as I said, I have seen it with a self-managed super fund once only, and therefore the benefit is flagged to say this is subject to a split at a point in time when a condition is met. But more self-managed super funds, and let's say ultimately the majority of self-managed super funds go down the splitting order, which is where they say, okay, well, let's determine, we've gone through the process of determining how much people have, right? Once we've determined that, let's work out who's getting what, how they're getting it, and let's affect the order immediately. So the splitting order is ultimately a point in time where a decision is made, and the parties decide how the benefits are going to be split, and then that process occurs relatively uniformly, quickly. I'd like to say efficiently after that point in time, but I know from the administrative point of view and the administrative experiences that I've had in this space, it doesn't always flow relatively smoothly. Now, the key, and I've often sort of referenced this in estate planning presentations and other and similar styles, is that the thing about splitting orders and the thing about relationship breakdowns versus, say, estate planning is that in largely the court order sense, you are being told exactly what to do. So generally the only admin hold up or process is one where trustees are being difficult in the way that they're acting to try and achieve the final outcome. It may also have something to do with liquidity issues and obviously the capacity to sell down assets to transfer benefits across. But unlike estate planning, where there may be that discretionary position from the trustee's point of view, these splitting orders don't give discretion to the trustees. Now, in a non-SMSF sense, you do need to provide sort of what they call procedural fairness to the trustees and notify them of the concept of the split occurring and provide them potentially with draft orders to make sure that they can accommodate the split. Again, because all the parties in this transaction are ultimately one and the same in the vast majority of cases, you make that assumption that procedural fairness has been provided, and the SMSF is well aware of what's coming and how to undertake it. And so therefore you take off your member spouse or non-member spouse hat and you put on your trustee hat to be able to perform the appropriate duties. But they're the order types that we get, and then we go into the payment types and how we're actually going to pay the benefit out to the spouse, to the non-member spouse. And this is where the market movements and a number of things will often dictate how and which method people will utilize. And again, I would say it's fair to suggest that in the cases that I've seen, it would be pretty close to a 50-50 split between base amounts and percentage amount split. And I think the reason largely for that, from a pure administrative point of view, is that largely the whole process sort of is accommodated by this concept of an operative time. And normally the operative time is within 4 business days of receiving the court orders or the signed court orders. Now, in essence, or receiving the superannuation agreement. So, whether that 4 business days is the appropriate time frame or not, from a pure SMSF accounting point of view, if we've got both members within the same entity, then in most instances, the capacity to actually transfer that base amount from that operative time, so from the immediate time that the court orders are received, that in itself should not be problematic, because we're talking about an internal rollover, because we can create a new interest for the member if the trustees so deem, or if the member elects that to occur. But if they're already a member, then it's quite easy to do that first up internal rollover, and then we're not having to contemplate so much base amount adjustments and other things in indexation, subject to not having undertaken that actual payment split. So that's why I don't necessarily see an issue with base amount payments, and have seen a good number of them occurring over time. Of course, not all members and not all trustees act and provide that information in an appropriate time frame, and from an administrative point of view, you're often working behind, and that's where, you know, it may be that some time has passed since the court orders or since the split has occurred, but nothing's actually happened in the super environment, and so there may need to be that adjustment, that base amount adjustment to sort of accommodate potential growth that the member has missed out on. Now, the thing about the indexation of the base amount and having that adjusted base amount is that it's ultimately or effectively an average weekly ordinary times earnings plus 2.5% or thereabouts interest rate. So it's not actually, excuse me, based on the actual investment returns of the fund. It's based on a legislated amount that is updated each year. And so in that instance, you know, that's where the base amount can clearly be detrimental, is if you base the amount that you're going to split on valuations that were attributable to, say, 12 months ago, because you'd had the financial statements prepared. Then you go through the process of getting the consent orders using those amounts. And in that time that the market has moved significantly either up or down, then one member or the other is going to be impacted by that potential growth or loss in the environment, versus the percentage split amount, where ultimately say, okay, well, here's the amount of money that we both have. We're going to split X amount from one member and then Y from the other member. Now, what we do see a lot in this situation is what you would classify effectively as a multiple split order, which is where the members may split 100% of member B's amount to member A, and then after that transaction's occurred, split 50% of member A's account to a new interest for the non-member spouse. And so that's how you would achieve the 50% of the balance of the fund, by applying that percentage split to the entirety of one member, having had all of the fund's interest transferred to that member in the first instance. So you do see those multiple splits occurring and achieving the desirable outcome of not really being impacted by market movement, and it being an equality-based split subject to both parties agreeing to it. And I think that's one of the key things to contemplate, is that a lot of these things are based on, you know, the capacity for the parties involved to make a decision. So you've got the choice as to how the benefits are split, and that then takes us on to the concept of whether or not we create a superannuation agreement or we go with consent orders. So these are ultimately our two methods, our two documented styles of actually splitting the superannuation benefit. So a superannuation agreement as such forms part of any normal financial agreement. So it's a document that, you know, when you've got separating couples, you can do this at any point in time in your relationship. You can create a binding financial agreement, and then you can incorporate superannuation into that agreement. And then you need to make a declaration to determine or to declare that you have actually separated, to ensure that process can be applied. So the process of undertaking what you've outlined within the agreement. Now, the point of the superannuation agreement, and it can be a separate document, so it doesn't have to be incorporated with your other financial agreement. You don't necessarily need another financial agreement. So you might actually deal with certain assets through the courts, and you might deal with superannuation separately, or you might deal with some assets through a financial agreement and deal with superannuation through the court. So there's no right or wrong situation. But if you are going to go down the path of obtaining a superannuation agreement, then one of the key differences between that and going down the consent order path is that both parties must obtain independent legal advice, and then that those lawyers must provide a statement to state that they have provided that independent legal advice, and that must accompany the superannuation agreement. So, if you look at the consent orders separately, yes, you do have court orders where parties can't agree, and therefore it's going to be put towards the court, and you'll have a hearing date. And that's where a lot of the information from the superannuation information kit, the Form 6, all of the stuff that's completed there and then put into the application for orders, that's when that will be debated, or not debated, but that's when that will be sort of ruled upon through the court system, and they will contemplate financial commitments. They'll contemplate all of the other commitments and personal commitments and caring commitments and all those sorts of things that come into a relationship. And so, a court order where hasn't been, or where parties can't reach an agreement is probably the longest and most drawn out and crippling for parties. Whereas a superannuation agreement itself, and then potentially a consent order, a super agreement will require that additional legal advice to be provided to both parties, and that can be a costly exercise associated with it. But at least you are making a decision based on how you want your superannuation benefits to be split. So it's done according to the wishes of both of the parties. And similarly with consent orders, the beauty of consent orders is generally they are agreed upon by the spouses, the two spouses, the separating spouses, and then you can make an application. So you have to minute those consent orders. Now you are likely to go and get those consent orders drafted up also by an appropriate lawyer, but it's going to be less financially impactful than actually having to go to court and front up to fight tooth and nail for your various assets. So by having the consent orders, the minutes to the consent order drafted up, you then provide it to the courts will rubber stamp it, and then they will send back, or they'll date the court order, and that then becomes the document to implement the splitting process and gives us our operative time. Now, the key there is that the consent order, once stamped by the family courts, ultimately makes the statement or makes the reference that you are separated. So the court is the body that determines that you are separated because you've made the application, you've made their declarations to them that you meet those conditions. Whereas under a superannuation agreement, because you're not going through the court process, you have to make a separation declaration. At least one party has to make that declaration to state that you have been living apart for longer than 12 months. There is no likelihood of effectively recohabitating with each other. And this declaration is an interesting one. And I go back to one of the very first early cases, and it's as meaningful today as it was back then, because back then I sat in a room with two clients, a husband and wife, and they said, look, we're here to split our superannuation. We're doing a superannuation agreement, or we're going to do it. We want to do a superannuation agreement. I said, you need to get the appropriate legal advice, and you need to get that signed off independently. So I was giving them the administrative process to that. And they said, okay, we can do that. And then I said, and the final step before we can implement it is you need to sign a separation declaration declaring that you have retired and declaring that you no longer cohabitating and you've been separated for more than 12 months. Now they asked the question, can we still be living under the same roof? And I said, well, based on the law, yes, you can be, but you effectively have to be living separate lives. And one of the parties, the husband, was very happy to sign the separation declaration, but the wife seemed a little hesitant, and particularly this was after I sort of started highlighting that there are penalties involved for making a false declaration from an asset separate or from a relationship separation point of view. And it turns out in that situation, and really the point to this is that it still exists in a transfer balance cap point of view, was that this trustee was well aware that that if they split their superannuation, that his large RBL problem that he had, which would now translate to a large transfer balance cap problem that he had, would effectively be split across from himself to his wife. And so instead of having, let's say, instead of having $3.2 million in his name, he would be able to agree to split 1.6 to his wife, and then they could both set up a tax-free pension. Now that was under the old school reasonable benefit limit, but the same sort of concept applies today, and that's what we have to be mindful of, is that this separation declaration is there to ensure that there is a genuine nature to the separation, and that it is not just effectively entering into a scheme to avoid things like the low rate lump sum cap, or the transfer balance cap, potentially total super balance rules with regards to making various styles of contributions. So if people do a payment split and move the money across, then they might be eligible to make further contributions. And so we want to ensure that the system operates in a way to avoid people undertaking transactions that are otherwise untoward. And so, that's why they have these false and misleading penalties associated with things like superannuation declarations or separation declarations, because of the examples that I've certainly seen face to face in the small meeting room. Now, needless to say that couple never did separate, because they had no intention of separating. And as the wife clearly pointed out to me, the reason they lived in separate rooms was because of his snoring more than anything else. But she did all the cooking. They went on all their holidays together. All their bank accounts were still joint, and so it was purely a taxation consideration. So one that we as SMSF professionals need to be mindful of. So we create that order, and as I said, we've got the opportunity to do a superannuation agreement, but we must undertake two stages. So we can prepare this at any point in time. So the term that often gets thrown around is a prenup situation, but it's effectively a binding financial agreement where we are saying, from our point of view, our superannuation, this is how we want our benefits to be split. Both parties then must sign off to say that they've got, or both parties must declare that they've received independent legal advice, and then the lawyers must state that they have provided that advice, and then we need to get the declaration of separation to be able to affect the superannuation agreement, versus the consent order, where you can ultimately do your superannuation agreement, put all that in the application for consent orders, draft up the minutes of the consent orders, and go and get that rubber stamped by the family courts to be able to start the process. So both strategies, both options are available to self-managed superannuation funds. So once we've got that, and we have the court's approval on how the process operates, then the notices, or the court order or the superannuation agreement, will be provided to the superannuation trustees. So it gets stamped by the courts. Let's say if we're using the consent order method, stamped by the courts, and then we effectively provide that to ourselves as trustees, and then we have our operative date. So we want to start acting within 4 business days of receiving that court order. Now, what we require there is we require a notice to the trustee. So the non-member spouse needs to provide details of themselves, so their address, their date of birth, details of their membership if it applies. That needs to be provided to the trustees, so that the trustees of the fund can communicate with them. The trustees are then required within 28 days to issue a payment split notice to both a member and the non-member spouse. So again, this is a little bit like the concept of stopping and starting and taking payments out of a self-managed super fund from a pension point of view, where you have to write to the trustee and then the trustee acknowledges it. It's a matter of going through that due diligence, so that if at any point in time this process is challenged, that you've actually got all the necessary supporting documentation in place. So you need to provide that document to both parties there, and then provide a notice to the non-member spouse when the interest becomes pay, or subject to the payment split. So you need to provide information of the base amount. You need to provide information of any adjustment to that base amount, if it is, if there is any adjustment required. If it's a percentage split, then identify how that payment split will occur. So that's effectively the trustee responsibility, is to prepare certain documentation upon receipt of the court documents. And then from there, the non-member spouse makes their election to either have a new interest created within the fund. So that's obviously going to occur if we've got, say, a single member fund. That's going to occur if we've got one of these associate style funds, or some other fund where the person isn't already a member of the fund. They can notify them to have their benefits rolled over to another fund. Now, quite often you will see, as part of the superannuation agreement, and this is why I state that self-managed super funds are often slightly different in the way they operate to other funds, is quite often you will actually see this detail incorporated into the court, or into the consent orders, or into the agreement, and that is to stipulate that X amount is going to be split from A to B, and then another amount will be split from B back to A, and then upon that second split, then A will request their benefits, or wish their benefits to be transferred to the XYZ superannuation fund, and then following the transfer of the assets out, and of course incorporating things like the taxation and any other payments at that point in time, and I'll touch on that in a moment, then the members take all the appropriate steps to resign as trustee or remove themselves as a director of the corporate trustee. So a lot of that information, which we will see occasionally documented in the notice split, the payment split, and the request from the member, will often also, in the SMSF sense, be accounted for already in the consent orders, because they've actually gone through that process of working through each step to make sure that they're following and have it well and truly documented for the purposes of ensuring that everything goes accordingly. So they can have a new interest, they can have their benefits rolled to another fund, or they can have the benefits paid out to themselves. Now, that, of course, is going to be subject to the meeting and condition of release. Of course, it could also be subject in the situation if you've got an older spouse and a younger spouse. If there's a member with unrestricted non-preserved monies, then because the components take on the same components from a proportionate point of view that the member spouse has, if that member spouse has unrestricted non-preserved benefits, then the non-member spouse can request the money be paid out. Now, in that sense, they would have to be mindful of, if they're under preservation age, what the tax ramifications are of withdrawing taxable components, so 20% plus Medicare. If they themselves are over the age of 60, then there's nothing really to see there with regards to the taxation liability. And if they're 59 years of age, then they're going to be subject to the low rate cap. And so, taking all that into consideration, they can have their benefits paid out to them. So, it's important that we get that advice, that request from the non-member spouse as to how their benefits are going to be paid out. And as I said, all of this leads from whatever the preservation and interest components are of the member spouse, and will be split accordingly. And so, when you start to look at these things in a non-SMSF environment, and potentially you're more, say, defined benefits and defined pensions and things, where the benefits are going to be split according to how the member has them paid to them. So if they're being paid a defined benefit, then they're going to receive those pension payments with the same style of split. And of course, it's not really an issue that we have to deal with largely in a self-managed super fund, but for the few remaining defined benefit interests, market-linked pensions and the like within the super environment, we do have to be mindful that there may be associated issues with trying to split those superannuation interests, and what it means from a member's benefit or otherwise. So all of those sorts of things become quite relevant. So again, that's where issues associated with these, I guess the amnesty around legacy pensions will certainly potentially benefit people, because it might be able to, at some potential tax cost, who knows yet what those rules are going to be, but it may provide an easier avenue to access superannuation monies. So you go through all that process, and then we have to start to contemplate the effect or the impact that it has on the assets of the superannuation fund as such. And I think this is probably one of the things that largely self-managed super fund members, particularly those that may not necessarily have been engaged in the admin sense, they may overlook this sort of issue with regards to if they look exclusively at member statements and those member statements don't incorporate deferred tax liabilities or future income tax benefits. So if we've got deferred tax liabilities in the fund, we have to make sure that our, this is a personal view, but you need to make sure that in the SMSF space, that if we've got that deferred tax liability, then the liability is taken in consideration into the split so that the remaining member isn't left with the tax liability attributable to both members of the fund and ultimately resulting in a smaller benefit to be paid out. So, when we're dealing with that side of things, that we are incorporating the tax on an actual taxation basis. But not all funds are going to contemplate that. And in some instances, the trustees will be mindful of it, but they may have some other carried forward losses that they're willing to offset future gains with, or they may contemplate that they're about to move into retirement phase anyhow, and they're going to be subject to exempt current pension income. So all of these sorts of things get factored into the decision, but your average self-managed super fund trustee is going to need some guidance on all of these things and all of these process as they move along. So they do want that level of support to ensure that they do and act the right way. So we do have the standard CGT rules that apply on the sell down of an asset to fund a payment split benefit as a rollover as such. And so we've got to work out whether we've determined the taxation in all that. But then part of the transaction or part of the discussion is going to be, where is the non-member spouse transferring their benefits to, and how will they transfer it? So if they're transferring it in cash from the self-managed super fund, then there's going to be the CGT event. If they're both in accumulation, you're going to have the CGT event, and then you're going to do a cash rollover. But if, for instance, they're looking to transfer the assets of the fund to either another self-managed super fund or a retail or industry fund, less likely, but it does happen with a number of, particularly the retail sort of wrap-based funds where they're more than happy to take on the assets of the fund. But it's one of those situations where what actually happens is that a CGT, effectively rollover relief, applies for small super funds, so self-managed super funds who transfer the assets of a member's interest where that member has been subject to a relationship breakdown or the requirements of the Family Law Act and the Family Law superannuation regulations. When the assets are transferred as part of their interest as part of that process, then capital gains tax relief can be applied, and the cost base that is picked up in the new fund is going to be the original cost base, and so therefore the CGT liability will be eventually moved across to that new, or the transfer, or the newer fund. Now, the question mark there becomes is that this measure, which originally only applied from small fund to small fund, now applies to any complying fund. But the administrative problem becomes, how does that retail fund, for example, how are they going to record the cost base of the shares? Because most in specie transfers they will record the cost base on the day of the transfer. So it's going to require a fair bit of administrative communication, and I suspect, whilst I don't want to use the word heartache, but I suspect it will cause some pain, administrative pain, in ensuring that the new fund can take over those measures, and be asking whether they're willing to do it. Whereas in the self-managed super fund sense, the capacity to rectify or to replicate the CGT of the fund in that new environment is certainly a lot easier, particularly if the fund is administered by the same party. That's not often always going to be the case, and they may have different advisors as well to contemplate in that situation. But the good thing is to know that you do get the the relief on the transferring of those assets. So I've got a question here. Is it the market value at the date of the transfer or operative date that determines the number of shares to be transferred? So look, that's it's a good question, and I think that's where the whole documentation process becomes really important as to whether it's, say, a dollar amount split or a percentage split. And I remember the worst one I ever had to deal with, and when I say the worst one, it was the worst one from an administrative point of view, because they were very specific in certainly the type of asset that they wanted to split. So they actually did an order down to the asset, but beyond certain assets, they then did it as a percentage base. And so, because they were trying to achieve a certain outcome, we had to find a date where we could value the assets, use the value of those assets to do the transfer from one to the other, but then also ensure that with that asset, what was the value of that asset at that time, and what impact would it have on the remainder of the assets or value to be transferred. So to me, it's the effectively, because you will be doing all the things like proportioning the assets or proportioning the members' benefit immediately before the transfer, so the tax-free and taxable components. So from a valuation point of view, because you want to get the tax-free and taxable components and all those sorts of things correct, you should ultimately be doing a valuation of the assets immediately prior to the transfer from a member benefit point of view. Now, of course, that sort of runs slightly counterintuitive towards changing or not changing the cost base, but because you want to get the valuation of the transfer right, to me, from a proportioning point of view, that's the way that you need to do it. So it can get overly complex in an administrative space if you are trying to value the member's interest to be able to determine the percentage split to do, but then you're not actually changing the cost base in the new fund when it's received. And so there's some form of slight anomaly there, because remembering that the cost base of a lot of these shares is from many years ago, not even from the operative time. So the cost base associated with the transfer is certainly from a pre-date, pre the separation of the parties. So to me, it's always the date of transfer that we're doing the valuation of the assets. Now, the second part of this is that this CGT relief is only available for one member interest. So if you've got two members and they both choose to leave the fund, then ultimately the first part and take their assets with them, then ultimately the first in best dressed scenario applies, and the CGT relief is only going to be applicable to that member. So it's one of those situations where generally you're not going to have both members leaving, and only one is going to transfer to another fund and take assets with them, and potentially this accommodates the associate style fund and other things, and where potentially the holding of assets via unit trust versus directly can benefit it, because you can transfer unit trust investments. But also, going back to the question of valuations, it shows the importance of getting independent valuations, because what might be the contemplation of a standard consent order application may turn into a court order because you don't agree on the valuations of the associated property inside the fund. And so you want to make sure all of those sorts of things are addressed up front. And so the flip side of the whole transferring assets to another fund and obtaining the CGT exemption is whether or not that other fund can actually acquire those assets from a related party, because we know that Section 66 has been in place since effectively the beginning of time with the acquisition of assets from a related party and the prohibitions to that. Well, one of the exceptions to the prohibition on acquiring an asset from a related party is the issue of the breakdown of a relationship. And so effectively, if those assets are acquired for the benefit of a particular member from the trustee of another fund, and the member of their spouse are separated without reasonable likelihood of cohabitating. So again, similar to the separation declaration that you're actually making in the first instance to operate under the superannuation agreement, you're effectively making a similar declaration when acquiring assets from the fund. So the CGT is ultimately just a pure taxation issue. Then the actual asset transfer has to satisfy the SIS compliance requirements And so from a SIS compliance requirement, you have to say, okay, well, the acquisition is an exception to the prohibition on acquiring an asset from a related party under subsection 2B of section 66. And therefore, we are satisfied that the member and the spouse are separated without any reasonable likelihood of recohabitating. And that acquisition has got to be directly connected with the relationship breakdown. So again, you've got to make sure that all of this occurs post the issuing of the court consent orders or the superannuation agreement. And you don't want to be in the process where members are separating, and so they set up separate self-managed superannuation funds and they start transferring assets before that point in time. Well, that's actually pre this whole the court order relationship breakdown taking effect, and that could, or you could end up running the risk of having a compliance breach from a SIS point of view. I don't know specifically, I haven't seen that actually occurring. I'm just sort of raising it as a bit of a red flag, is to make sure that everything happens after a point in time, not as a precursor to that point in time. So you've got that acquiring assets from a related party matter to also consider. But it is a good thing to contemplate. And again, if you then marry that together, marry being the wrong term there, but if you bring that together with the concept of the capital gains tax relief, then and original cost base, then it puts to bed a lot of the questions that I saw in the early days about things like pre-99 unit trusts and other assets, and whether you can transfer those assets and whether they can retain their original cost base. In a post-2009 environment, we saw a lot of people, well, not a lot of people, but you saw people contemplating whether or not that trust could be moved from one self-managed super fund to another and still be considered a pre-99 unit trust. Well, effectively the CGT relief put together with the acquisition from an asset from related party rules ultimately retains that asset in that superannuation environment and gave people the comfort that they needed that the asset retained that pre-99 requirement. Pre-99 requirements, things that long forgotten in many conversations, but it was certainly valid and important to people back at that point in time. Which sort of brings me to the end of the presentation from the main issues associated with separating and paying out member benefits. But there's then a couple of, I guess, key issues that I want to finish off with, just to put out there as a bit of a reminder. And that is, as I highlighted the client who did or tried to do a marriage separation for the purposes of reasonable benefit limits and taking larger superannuation lump sums, and ultimately that didn't wash. But the same thing really ultimately applies now with transfer balance cap reporting, and also the rules applicable to total superannuation balance. But from a transfer balance cap point of view, if you've got someone that's in receipt of an account-based pension, then you're going to have the debit of the partial commutation and then the credit to the spouse if they choose to commence a pension. But if we're talking about unrestricted benefits, then there's no requirement for them to start that account-based pension. They can obviously take the proceeds out of super, but at least the member spouse gets the debit of the value according to the payment split. So we've got to make sure that the members do their appropriate reporting, and the partial commutations or full commutations, as they may be, are reported appropriately. The fund trusteeship, obviously, it's a key issue to ensure that parties understand what their obligations are. And as I said earlier, they're often, what I've seen in the situation is all this is addressed in the consent orders. And so if there's a corporate trustee, it goes through the process of saying, okay, this is the split and how it will occur. Once the split has occurred, the benefits will be rolled over to X. And then once that has occurred, then member B will resign as trustee of the fund or as a director of the corporate trustee, and will no longer, will stand down as a member of the fund. And so you work through all that process. And of course, if you've got individual trustees, it's ensuring that then the fund does the right things necessary to make sure it meets the definition of a self-managed super fund. So either appointing an additional trustee or changing over to a corporate trustee. And I think that then leads to the final question, which is they've gone through this entire process, and it's a little bit the same whether it's estate planning or marriage breakdown or relationship breakdown. Is a self-managed super fund then the right vehicle for the remaining member, and often the assets will be the determining factor in that decision, and also whether or not they've got the capacity or desire to remain as trustee of the fund now that they're operating in a different environment to what they were doing previously. But I think that becomes a critical issue, particularly if the balances have been significantly drained from the actual transaction. So, as I said, there's a bit of an overview from the administrative point of view, is that the things that we need to be mindful of, the documentation we need to prepare in applying or doing court or relationship breakdown separations, ensuring that the fund meets its compliance obligations and not just relying on the court documents or the super agreement as the only document in the process. So, it is a critical step. With younger self-managed super funds, we are likely to see more and more of these occur over time, and again, potentially with the 6-member funds, it will bring a different breed of member to the SMSF environment that we need to be mindful of. So, look, thanks very much for joining me at today's presentation. I had a number of other stories I could have told, particularly the one about the SMSF that tried to transfer their laptop under a marriage breakdown process. That was a bit of an awkward situation because it should never have been a fund asset in the first place. But I guess the key issue with these is to aid the parties as much as possible, but to be mindful of the boundaries between what is advice and what is not advice, and for them to seek the appropriate legal and taxation advice with dealing with the steps. So thanks very much for joining me. I look forward to speaking to you all again in December for our final webinar on the year. So look out for the topic and the date for that shortly. Thanks very much.